Okay, good. And so let's just go ahead and take a look at the material here for chapter 5 and put it in full screen. And where we had left off, okay, find that here. We had left off talking about, we were talking about the attestation standards generically, and we talked about a type of engagement that falls under the attestation standards called agreed upon procedures. And now we're going to get into prospective financial statements. Now, what we're going to see is that it's going to get a little bit interesting as we talk about the prospective statements, because some of the work that you do on prospective statements are done under the attestation standards, which we've started talking about now. Some of them are engagements with prospective financial statements are done under the statements for standards for accounting and review services. We'll get into statements on standards for accounting and review services, SARS, in chapter 6, but we're going to talk about everything relevant to prospective financial statements in this chapter. Okay, so even though we're sort of under the statements on attestation standards discussion right now, we are going to be talking about some engagements for prospective financial statements that actually fall under a different set of standards, the SARS. Okay, so we take a look and we have two different types of prospective financial statements. We have financial forecasts and we have financial projections. Now they're similar, but there are important distinctions between these two types of prospective financial statements. Prospective financial statements, of course, are forward-looking statements. For example, let's say I want to open a restaurant and I'm trying to attract investors to my restaurant business, and I'm sitting there saying, well, hey, here's what my financial statements are going to look like at the end of the first year. Would you like to invest? Okay, so that's what prospective financial statements are for. And in one case, in the case of the forecast, the prospective statement is based on expected courses of action. For example, maybe I've already received a loan from a bank. I have the loan in place. I'm going to be opening the restaurant, and now I'm just trying to attract additional investors who may want to come in and buy a share of that business. And so I go out to some sort of general meeting where I'm trying to get that kind of an investment. Okay, that would be an example of where you'd use a financial forecast. Okay, now for a financial projection, that sort of prospective financial statement is based on hypothetical assumptions. It's based on a what if type of scenario. For example, I don't have a loan from the bank yet, and I'm going to the bank, I'm saying, if you give me the loan, then I will be able to do this, and this is what it will look like after 1 year, the hypothetical assumption there being the bank loan. So what's important and what we need the flashcard here is, I mean, all of it's important, but what we want a flashcard here is what are appropriate uses for these prospective financial statements. And they tell us that you can use a financial forecast and a financial projection. Both are okay for general use. General use meaning I'm not negotiating directly with the party that I'm preparing these statements for. So the forecast is okay for both general and for parties I'm negotiating directly with. The limited use falls in for the projection. Only a projection is appropriate for limited use. Okay, and when we talk about examples of parties that I'm negotiating directly with, that's going to be, for example, the bank. I can use a forecast for that. Okay, so when you look at the use, and I think they've just called them both out here, general use means that the statement is issued by issued by parties not negotiating directly with the responsible party. Only a financial forecast is appropriate for for general use. I think I said that backwards. Don't worry, guys. I've only been teaching this stuff for 30 years, so it shouldn't, be a problem that I have to end up saying it backwards. Let me start over. General use. Only the forecast is appropriate for general use. Only the forecast is appropriate for general use. Okay. The let me look at maybe if I look at my notes here. Only a financial forecast is appropriate for general use. I guess that's all they say there. Limited use means that you can only use it directly with the parties that you're negotiating directly with. And that's when you can use a forecast, but you could also use a projection. Okay, so only a forecast is appropriate for general use. So since I've completely wet the bed on what I'm trying to say to you here right now, let's just do a flashcard right here. I'm going to just go ahead and dictate a flashcard for you, okay? Just so that this can be cleared up here. So I'm not going to write it. Just go ahead and write something down somewhere what the flashcard is going to be. I'm not going to write it. Okay.
So, can I ask you a question? So for general use?
No, you can't. You can ask the question after I do this flashcard.
Okay, all right, thank you.
Question, then you can answer it. Okay, all right, so just write this down somewhere, maybe right there where I've indicated. True or false? It's going to be a true or false flashcard. True or false? True or false? Write it down. If you don't write it down, you're gonna have a problem in this area. So get a pen, write this down. True or false? Okay. Okay, true or false? Both financial forecasts and projections are okay for general use. Both financial forecasts and projections are okay for general use. What's the answer? Answer is false. The answer is false. Only the forecast is appropriate for general use. Only the forecast is appropriate for general use. Okay, so the flashcard should say both true or false, both financial forecasts and projections are appropriate for general use.
Million
The
thing.
answer is what? The answer is false. Only the what? Only the forecast is appropriate for general use. Only the forecast is appropriate for general use. Now you can ask your question.
So when you mentioned about the forecast, financial statement, it's not the final financial statement. I'm confused about the forecast.
Forward looking, nothing has happened yet. When I prepare financial statements that we've been talking about throughout the class, a year's worth of activity presumably has gone by, and I'm preparing the financial statements based on that historical happening, right?
Okay.
Prospective means forward looking, means nothing's happened yet. Right now, all I have is a hole in the ground. I'm going to build a restaurant and I'm going to open the restaurant, and I'm showing you what the financial statements will look like after that first year.
Okay, so it's just a projection. Okay, got it. It's just an estimation.
It's a projection or a forecast, but yes.
Forecast.
We have forecasts, we have projections, both are prospective, forward-looking financial statements.
I see. Thank you.
Okay, and only the forecast is okay for general use. That's it. Only the forecast is okay for general use. Okay, a projection you're going to be using if you're negotiating directly with the party. For example, you're working with a bank, and the Projection is based on hypothetical assumptions. So you're probably saying, hey, if you give me the loan, this is what will happen. If you don't give me the loan, this is not going to happen. For the forecast, you're sitting there saying, I have a loan from the bank. I'm just trying to attract additional investors, right? Maybe you're going out generally the general public or something. Okay. Okay, good. Now you come over and the types of engagements, okay? And a practitioner could be engaged to prepare these prospective financial statements. That falls under the SARS, Statements and Standards for Accounting and Review Services. Even though we're talking about the attestation standards when we started this module, we're going to be talking about activity that would be appropriate for a preparation of the prospective financial statements, which falls under the SARS. You can compile the prospective financial statements. That falls under the Statements on Standards for Accounting and Review Services. You can examine. Basically, you're going to be giving an opinion, positive assurance on the prospective financial statements, and that falls under the attestation standards, Statements for Standards on Attestation Engagements, SSAE. Okay, and then you could perform agreed upon procedures on these prospective statements, and that falls under the attestation standards. Okay, all right, good. So let's look at those engagements now. Oh, very important, I almost went past something that I definitely want you to flashcard. You cannot review prospective financial statements, and we're going to talk about reviews in the next chapter, but you cannot review prospective financial statements. So flashcard that, and here's the reason. One of the big procedures for a review of financial statements in which an auditor gives negative assurance. Negative assurance, as we said last time, is where the auditor says nothing came to my attention that there's anything wrong with the financial statements. And the big procedure that you do there, one of the big procedures, is you do a set of analytical procedures. So you compare last year to this year. Well, there is no last year. There is no solid happening that we can compare these statements to be able to do a review. So they say, no, you can prepare them, you can compile them, you can examine them, but you cannot do a review. And the big reason is that you're not able to apply any kind of real meaningful analytical procedure to something that hasn't happened yet. Okay. Okay, good. So now when we take a look, if we're preparing the prospective statements, okay, then that's the SARS. SARS provides the guidance that we'll talk about in the next chapter, but it is very similar to the preparation of historical financial statements, and we'll talk about that in the next chapter. We'll get into that really in A6 in more detail. Okay, so let's just take a look. I'm trying to write A6 there. My pen didn't change for me. A6. Now let's just take a look, and practitioners should not prepare prospective financial statements if they don't get a summary of significant assumptions. So even for the preparation, okay, when you give a preparation, you're just going to prepare the statements, and there's going to be, you can put here, no report. There'll be no report. There's no report in a preparation. You just prepare the statements and you walk away. You don't have to put any report out, nothing, okay? However, you still have to ask me to provide you with the summary significant assumptions. So I'd have to tell you, well, the reason I'm saying I'm going to have, $500,000 of revenue in the first year is that they are going to open up a school, a university across the street from me. And students like to come out and eat food, when they get a break or whatever, okay? And that's what's going to generate this $500,000 worth of revenue. They're going to open up a hotel. down the street, and I'm going to have some people, foot traffic now that I maybe don't necessarily have now, and that's how I'm going to generate revenue, whatever. Okay, so I'd have to at least provide you a listing of my assumptions, and you don't have to do anything to validate the list that I give you in a preparation anyway, but you would have to at least understand what those assumptions are. And if there is some sort of hypothetical assumption, meaning that it is a projection, then you have to identify the hypothetical assumption and understand what that is. So you'd have to get that information from me as well. Okay, but you don't have to validate any of this. You just simply have to say, understand what my assumptions are. Okay, now if you compile a set of prospective statements, a forecast, a projection, whatever, now there will be a report, but there's no opinion. So you give no opinion, you give no assurance at all. There's no assurance at all that's given, but you do issue a report. So it's very similar to the preparation, but now there will be a report. And again, we're under the SARS. Okay, so the purpose of the compilation of prospective statements is the proper assembly of the financial data on the responsible parties' assumptions, and you're going to issue a report. Okay, now there is no assurance of any kind given on these statements. Okay, let's just go ahead and flashcard some key points here as we go through. The accountant, however, even though you give no assurance, you should read the the prospective financial statements for obvious errors or obvious, information in there that isn't consistent with the assumptions. Okay, so you read the prospective statements with a summary of significant assumptions and accounting policies and consider where they're presented in conformity with AICPA presentation. Now, this gets a little confusing because we're used to what? The Financial Accounting Standards Board telling us what the form and content of the statement should be. Here, it's the AICPA that prescribes what the form and content of prospective statement should be. You're not going to be giving any assurance. You're not going to be doing any work to validate any of the information that's in there, but you at least need to read it for obvious areas where it's not in conformity with the AICPA presentations standards here for the prospective statements. The practitioner is not required to gather supporting evidence, but should be aware of obvious inappropriate assumptions used to construct the statements. And since we're not giving any assurance, independence is not required, but the lack of independence should be disclosed in a separate paragraph to the compilation report. So flashcard those key items there that I highlighted. Okay. Now you come over and yes, we are going to have a report, right? We will have a report, unlike with the preparation where there is no report. Here we will have a report, and the following items would appear in that compilation report. And I just want you to flashcard the ones that I highlight for you here as to what goes into the compilation report. Remember, guys, even though I think, somewhere out there in the ether, maybe on the video recordings or something, Garrett or whoever does this lecture says, memorize every report. No, we're going to memorize just the what? Just the standard report for the audit of the historical financial statements. The rest we're just going to flashcard and understand by analogy, how these reports work compared to what the report that we have memorized. So come over and there will be a statement that the practitioner has performed the compilation in accordance with the standards for accounting and review services, the SARS, that are promulgated by the AICPA's Accounting and Review Services Committee. So they want you to call out the standards. That's sort of like the scope paragraph, okay? You will give a statement that the practitioner did not examine or review the prospective statements. Now, we're not allowed to review them, but we have to do that. We basically do what? if we're saying that we didn't examine, we didn't review, which are reports that give some sort of assurance, this report isn't giving any assurance, then we are what? We're disclaiming any assurance. This is equivalent to disclaiming any assurance. We're basically saying, hey, we didn't audit them, we didn't review them, although we don't call it an audit, we call it an examination. Okay. A caveat that the prospective results may not be achieved. Hey, look, you know, John's saying he's going to make all this $500,000. You know, he might be the worst restaurateur in the history of restaurants. Okay. And this thing's going to flop. Okay. So you have to put that caveat statement in there, and a statement that the practitioner has no responsibility to update the report. Okay, so if you see me standing on the street corner somewhere where the restaurant was supposed to be, you know, 6 months from now, and I'm standing out there going, she took the boys, then you're going to have to just sit there and say, oh, well, you know, stuff happens. You don't have to run around and start saying, hey, you know, we said maybe in a year all this, it didn't happen. No, you don't have to update. Okay. Okay, good. Now that's for the contents of the compilation report, and that is for the and they show you the compilation report for the financial forecast. Okay, so those are requirements for the forecast. Those are requirements for the projection. But then when you get to the projection, okay, then you have to add in there that the standard report would be added to say that it is a projection rather than a forecast. So they show you the forecast, you know, you have to call it out for what it is. It's either a forecast or it's a projection. You have to call it out properly. Okay. Now you could examine the prospective financial statements. And if you examine the prospective financial statements, you will give an opinion. You will give a positive assurance. Okay, you're going to give an opinion, positive assurance on those statements. And the opinion, okay, is to state that the statements are presented in conformity with the AICPA guidelines and there's underlying assumptions. So now you're going to have to get underneath those assumptions and see that there's something that supports it. Hello. Welcome.
Hi. That was unpleasant. I've spent the last half hour trying to sign on.
Yeah, I think something might be going on because we kind of had a slow trickle in and we're still a little low on the usual turnout. So I'm not sure what might be going on with the system, but what we're doing is, Kathy, we're talking about something called prospective financial statements, which are
I really wanted to hear about that. That was confusing.
Okay, well, we're talking about forward-looking statements, and some of the key takeaways at this point have been that you can only use a financial forecast with a general audience for financial projection. You use those with who you are negotiating directly, say a bank. And we've talked about compilations, and we've said that for a compilation, there's no assurance at all that's given. And we talked about the contents of the compilation report. Now we're talking about an examination. And for an examination, we actually will give an opinion. We will give an assurance on these prospective financial statements, and the what we're going to do is we're going to give an opinion that the statements are prepared in conformity with AICPA guidelines. Now, what that means is the AICPA kind of acts like the FASB for prospective financial statements. They're the ones that say what the form and content of prospective statements should be, and we'll give an opinion that, yeah, these statements were prepared in accordance with those requirements, and we will also be looking to see that there's some support for the underlying assumptions. So I've been using the example that if I'm opening a restaurant and I tell you I'm going to make $500,000 of revenue the first year, and we're trying to, you know, examine these prospective statements, you would have to say, well, what are you basing that on? And I'd say, well, they're going to open, a hotel down the way, and that's going to create a lot of foot traffic, and that's how I'm going to make all this money. Well, you might look and say, well, do you have any information on the zoning for a hotel? Or have you talked to the builder of the hotel? Or maybe the hotel is there and set to open at a certain date, and you start to get some information that will help support what it is that I'm saying is going to happen. Okay, so go ahead and flashcard what the purpose is. Okay, and then come over and flashcard also that independence is required. Anytime you start to give assurance, independence is required. For compilation, because there's no assurance, we don't have to be independent, but we have to disclose in the compilation report that we are not independent. And then for a preparation, there is no report. We talked a little bit about preparation as well. Okay. Now, again, they're reminding us evidence is required. Sufficient evidence must be obtained to support the presentation. Okay. So we're going to need some evidence to support that. So go ahead and flashcard that, well, we kind of already, let's just go ahead and flashcard that evidence is required. It's not for a compilation, it is for an examination, which is essentially an audit of those prospective statements. Okay, now let's go ahead and take a look at the contents of the examination report on the prospective financial statements. And we're going to have, and I'm going to put flashcard like that out there in the margin. That means I want you to flashcard the items I highlight here. So a title that includes the word independent, okay, an identification of the responsible party, which is probably management, whoever's saying, hey, this is what my restaurant or whatever is going to look like for the prospective statements. A statement that the examination was conducted in accordance with the established AICPA standards. So AICPA is wearing two hats here. They're wearing the hat telling the auditor what to do, but they're also wearing the hat telling management this is how you should present the prospective information. So because the FASB doesn't get into little things like that. FASB thinks about big things that affect historical financial statements. This is something that is probably smaller prospective statements. That's where the AICPA steps in and says, okay, we'll give some guidance as to how these statements are to be prepared. So this is more the scope paragraph, right? This is more giving you scope, okay? Come over and to the next page and continue this flashcard. So this flashcard is continuing because this is the contents of the report. And I'm just asking you to highlight the ones that are to flashcard the ones that I'm highlighting, right? So it's one big flashcard that lists the important things that are in the report, and there will be an opinion that the prospective statements are presented in conformity with AICPA guidelines. So here is where the AICPA is essentially telling you this is how these statements should look. This is where they're acting like the FASB, okay, in this space, right? And the guidelines that the underlying assumptions provide and the underlying assumptions provide a reasonable basis for the forecast or the projection given the hypothetical assumptions. Okay. Now, for a projection, the report should also include a call out of the hypothetical assumption. You would say, even if he gets the loan, there will be differences between what we're putting down and what is going to actually happen. So you'll still have that caveat statement, okay? And a statement that the practitioner assumes no responsibility to update the report. So you still have the caveat statement, just like you do in the compilation report. You still put the statement that the practitioner has no responsibility to update the information. If you find out, hey, my restaurant didn't do too well, you don't have to run around and try to say, hey, don't give them any more money because things aren't going well. You don't have to do that. And for projection, now you have to restrict the report, because remember we said that a projection can only be used with parties you're negotiating directly with, right? So you'd have to note that restriction in there. Question?
Yeah, I don't know if you covered this before, but I was confused about the difference between a prepared statement and a compiled statement, other than the fact that the compiled statement has a report.
That is the difference.
Oh,
That's,
okay.
that's the big difference. The engagements are very, very much the same. The difference is I don't have to issue a report if the terms of the engagement are that it's a preparation. And you say, well, why would someone not want to report? And my answer to you is because they don't have to have one, because nobody asked them for a report. So, but if someone's saying, well, I want to see a report, somebody's saying I need a compilation, they got to get a compilation. But the idea when they came up with the preparation idea was that, hey, sometimes an accountant just is going to go in and provide this service to a client, and the client isn't going to really be doing anything that scary with those statements if there's no report on top of it. I mean, how would you be willing to invest with somebody who's just waving this? Look at what's going to happen after 1 year, man. Look at all this money. So invest in me. Well, you're probably going to look at that and say, no, I don't think so, right? But if it's somebody that you know very well and you're intimately involved with whatever it is, and they're showing you that and you're looking, then you're okay. And it's not going to make any difference to you if you have a report or not. Well, at one time, CPAs couldn't do any of that kind of work for somebody because we weren't allowed. We always had to issue a report. And when you issue a report, there's a certain cost associated with that. So you're going to have to charge for that. Now, if you're in a situation where you don't know the person as well, you'd at least like to know that there was an accountant involved reading the statements for obvious errors and that kind of thing, but it's still no assurance. Okay, so you'd say, okay, well, that makes me feel a little better that there's a compilation. You go past that and you say, no, I want somebody coming in and shaking their head and saying, yeah, these assumptions are reasonable. There's still a caveat statement in there that it may not turn out the way because we don't have a crystal ball, but the assumptions seem reasonable. Now you're feeling a little bit better about what you're getting there. So that's sort of how the chain moves on the different types of engagements. With a review, you give negative assurance. Negative assurance says nothing came to your attention that there's a problem, but the standards do not allow us to review prospective financial statements. You are not allowed to review them. And the main reason there is that reviews rely significantly on analytical procedures, like comparing the budget to actual, comparing last year to this year. Well, a prospective financial statement is sort of a budget. There is no actual. This year to last year, there is no last year. In fact, there's no this year yet. There's only future year, right? So, so they don't let you do a review. Okay, good. Let's take a look. They give you the report, guys. I don't want you to memorize the report. That is not necessary. I think Garrity says that it is not necessary to memorize the report, but I do want you to flashcard those key elements. And then if it is a financial projection, okay, you would need to call out the hypothetical assumption. You would say, even if he gets the loan to open the restaurant, there will still be differences between what we're saying here and what actually happens. So you're kind of embellishing that caveat statement a little bit. And you mentioned that hypothetical assumption in both the third and fourth paragraphs. And then again, you need to restrict the report. Okay, so flashcard, what happens when it's an examination. Okay, all right, so what I want to do is another true or false flashcard right here, guys. True or false, okay, because there's a lot of things moving around there as to when we have to put the hypothetical assumption, when we don't, that kind of thing. So let's try to do a true or false flashcard that will kind of crystallize that for us. And I'm not going to write it because my writing is awful. So just listen to the words that are coming out of my mouth and write them down somewhere on your notes there. Okay, maybe right where I've indicated. Okay. All right. So true or false? True or false? Both financial forecasts and projection reports are required to provide a caveat statement, call out hypothetical assumptions, and are restricted in use. And call out a restriction in use. Let me say it again. Both financial forecasts and projections contain caveat statements, call out hypothetical assumptions, and call out restriction in use. Did you get that? Did you get that? I'm going to take that for a yes. I'm assuming that you're, I'm assuming that I'm not talking for my health here, right? On what I'm asking you to put in this flashcard.
Yes, I think we just all had it on mute.
Okay, but we're good,
Yeah.
right?
Yes.
We're able to write, okay. Okay, good. And the answer to that question is what?
True.
No, the answer to that
False.
question is
False.
false. Okay, false.
Reference the
Only,
hypothetical assumption.
well, the answer is
That's for
false.
projection.
And stop. The answer is false. And what you can write as an explanation for yourself of why it's false is that only the projection report calls out the hypothetical assumption and is restricted. Both have the caveat statement. Maybe that's the way to write the explanation. Both have a caveat statement, but only the what? Financial projection contains a call out of the hypothetical assumption and a call out of restriction. Question. Okay, you got that? So we can move on.
I do have a question about something related.
Mhm.
There, apparently you can do a review on a pro forma, but not a prospective financial statement.
Well, let me get to pro forma. Let's go to pro forma. And that's correct. Okay, for a pro forma financial statements, let's look, are not prospective financial statements, but they may be used to demonstrate the effect of future hypothetical event by showing how it might have affected the historical financial statements. So if it had occurred during the period covered by those financial statements. So let's say I get through my first year, I have some actual results, and then I say, well, if I had a bigger dining room and bigger kitchen during this time, this is what things would have looked like. And I'm saying that because I'm probably going to knock out the building, knock out the wall in the building next to me and do exactly that, right? So now I'm saying, well, this is what happened last year. But if I had a bigger dining room, bigger kitchen, which is what I'm thinking of doing, then this is what the statements would have looked like. Okay, my revenue would have been 1/3 greater. Okay, well, now they tell us that they can be examined or reviewed because now we have historical data that we can apply some sort of analytical procedure against that would give us, some level of ability to give the negative assurance that is contemplated in a review.
So it's because it's based on historicals that you can review pro formas. Is that a
Correct,
correct
because there's
statement?
something has actually happened. reviews, use analytical procedures, and analytical procedures are based on real happenings, not on imaginary things. So they sit there and they say, I don't know. I mean, someone could argue and say, well, wait a minute, why wouldn't it be okay? Well, hey, look, the day the AICPA knocks on my door and asks me to help them write standards, which I don't think is coming anytime soon, I'm not going to have input into that because there probably could be some arguments back and forth on that. But they've decided, no, we don't want you to review prospective, but for a pro forma, yes, that's okay. Okay. Now, you still need to obtain an understanding of the event and evaluate the pro forma adjustments, including assumptions, and the practitioner obtain written representation from management. And I'm just going to put in here, check math reasonableness. That says reasonableness, if that's a word. That says reasonableness. Check math reasonableness. Math reasonableness. Check math reasonableness. So what are we saying there? Let's say I tell you, well, I'm going to add, capacity that's 10% greater than what I had during the period covered by these pro forma statements. And then I show you that the revenue is going to increase by 50%. You'd say, well, how is that going to work? I mean, unless you're thinking you're going to be able to raise your prices or something, that doesn't mathematically make sense. Okay. And that might be the kind of analytical procedure you would perform that would support a review. So you're going to check the math reasonableness, and then the practitioner should also, the CPA should also make reference to the financial statement from which the historical information was derived, and state whether those historical statements were audited or reviewed. Okay. All right, good. So flashcard, the information about the, down here, about the pro forma statements. Kathy, we're good on that now?
Yeah, that was helpful. I got myself, when I was reading this, I got all twisted around here.
I can't imagine why. I mean, it's all just so straightforward and easy to read. So hopefully that's the value added that I'm bringing to the table, which is I'll sit there and I'll read it, and I'll either explain it to you or tell you that it doesn't make any sense. One of the two.
I think I got confused because I hadn't realized how precise the terminology was, because I think a lot of people, certainly in the banking community, use the terms, projections and pro formas kind of interchangeably without realizing that they actually, in an accounting context, mean a specific thing. So.
Yeah, I mean, when I teach introductory to financial managerial accounting at Stanford to, folks that are in the School of Medicine, that are getting into the business side of things, folks that are in the engineering, management science and engineering, who, are hopefully going to be entrepreneurs and, be the next Zuckerberg and stuff. What I have to do is Will Smith them away. I have to slap them away from some of these concepts, that they think they know what they're talking about, but they don't. And so I feel that one of the main things I can add to that class is getting them away from doing the kind of thing that you're doing, that you're saying you hear that, banks do, because it creates there's nothing worse than thinking you're knowing what you're talking about and thinking you're knowing when you don't know that. And that I've just seen that it's like a cancer that lingers around, business discussions and whatnot. And so it's important to kind of extract that out, and so that everyone's on the same page about what's going on. So, okay. So let's go ahead and we did question 1 last time. Okay. So let's go ahead and let's start with question 2, and I'll go ahead and I'll put the poll up. You know, one thing I think I forgot to tell you, and I think it's going to affect our ability to answer a question. And I just realized I forgot to point it out. One second, guys. Because we said, is it? You say you can do agreed upon procedures, and then they talk about preparation, they talk about compilation, contents of the report, reference to the hypothetical assumption. Okay, there it is. I think I know. I missed it because I kind of rushed off to the pro forma statements. But come over to page page 50, where they talk about the agreed upon procedures. Okay. And when they talk about the agreed upon procedures, the conditions and required elements for agreed upon procedure engagements also apply when engagements are related to prospective financial statements, and additional reporting requirements include a reference of the prospective financial statements, a disclaimer on whether the statements are presented in conformity with the AICPA guidelines, and whether the underlying assumptions provide a basis for the caveat that prospective statements will not be achieved, and that the account assumes no responsibility to update the report. So you have to reference the prospective statements and a disclaimer as to whether the statements were presented in conformity with the AICPA guidelines, and whether the underlying assumption provide reasonable basis. So you disclaim that, and you still give the caveat statement and a statement that you have no responsibility to update. Okay, so flashcard those elements there. They kind of didn't do it in a bullet form, but that's sort of similar to what we talked about that needs to be in the reports for the compilation and the examination of the prospective statements. Okay, all right, good. Now let's come back down and go to the questions. Again, I don't, believe in reading through those reports because we flashcarded the key elements. Okay, looks like most of us have had a chance to look at this one. So if you haven't selected yet, go ahead and do so. And of course, the last person that came in ruined our perfect score here. Okay, so one person, the last one that came in, picked B for some reason, but let's go ahead and let's take a look at this. Almost everybody got it correct. It's C, and accepting an engagement to examine an entity's financial projection would most likely be appropriate if and it's a projection. If it's a projection, you can only use it with parties you're negotiating directly with, which would be what? And we use that example, a bank that you're trying to get a loan with. Potential stockholders are a general audience. All employees are a general audience. So that's why the other three were, of course, incorrect. Question? Okay, good. Let's go ahead and let's take a look at question 3. Okay, guys, looks like everyone's had a chance to take a look at this one. And we had the same kind of situation for this one. Almost everybody chose it, and then one person chose it correctly, and then one person got A here. So let's just take a look. And if the person that chose A would like to ask a question, that would be helpful, I think, because when a CPA examines projected financial statements, which are what are forward-looking statements of things that haven't happened yet, what should the report say? Well, explain the principal difference between historical and projected financial statements. There are no historical statements in this case. Nothing's happened yet, and there's not going to be just a, it's not a textbook where they're going to start writing. This is the difference between historical statements and projected statements. I mean, if we're calling it a projection, people should know that it's not historical. B, yeah, we have to evaluate management's assumptions, and we are going to say, hey, we did this, right? Refer to the CPA auditor's report on the historical financial statements. There are none. And, it'd be kind of funny to start talking about the ability for a client's ability to continue as going concern on some business that hasn't even started yet. So there's no such requirement there. Okay. Okay, good. Let's look at module 5, reports on controls at service organizations. And guys, I'm going to have to close this blind here because it's gonna be bugging me here till as the sun sets. Okay, let's go ahead and let's take a look at reporting on controls at a service organization, module 5. So what happens here? Well, you can see in the introduction that many entities use outside organization to process some of their transactions, and they mention, I don't know, does Paychex do much anymore? I think ADP just kind of like took over all the business. ADP is so big now that they actually give information before the job reports come out, the employment reports come out by the government, and they usually are pretty much on target because they're processing payroll for practically the whole country, right? And so they actually have enough data to be able to kind of circumvent, what do they call it when you usurp the government's ability to come out with these reports. So anyway, although everybody quotes the government's report, but sometimes you'll hear a report that ADP said something. So what happens? Let's say I'm an auditor of a company. They have payroll, of course. Payroll is an important transaction cycle. I need to audit the assertions that are associated with that transaction cycle, like we learned in, I guess, chapter 4. And, you know, I want to understand something about the internal control. So I started asking about the internal control, and the client says, hey, wait a minute, look, everything is done at ADP. And, you know, you're going to really need to understand what they do. So I go and I knock on ADP's door and I say, hello, I'm here auditing your customer, my client, and I need to obtain an understanding of the internal control sufficient to evaluate the design of the control, determine they've been implemented, and then I have to make an assessment of the risk and material misstatement. And if that assessment is less than the maximum, I'm going to have to test the operating effectiveness of the control. And ADP says, okay, keep an eye on this guy, let him in, let him do what he has to do. Well, as soon as I leave, what's going to happen? Here comes the whole world knocking at ADP's door saying we need to do this work. Well, ADP would collapse with and being inundated by auditors. So what we've come up with is this service auditor report in which ADP will have an audit done, and the service auditor issues a report. And now when auditors that are auditing ADP's customers come to the door, they're called the user auditor. They just take that report, you copy it into your work papers, and depending on the level of work that was done there, you can use that to cover your requirements for your internal control work over the payroll cycle. That's what we're talking about here, okay? Now, the way I described it, you'd say, hey, can I go over there and knock on the door and all that? Of course, you would know as an auditor, hey, you would just ask the client, do you have that report? And if the client says, well, no, we don't have it, well, can you please get it for us, right? And then you would get that from ADP. Okay, now you come over, because I guarantee you ADP has it. Okay, so you come over, and it turns out that there are actually 2 types of these service auditor reports. There's SOC1, and then there's SOC2, where my pen goes, okay, where my stylus goes. So for SOC1, and I think they get a little silly with these, you know, restricting trademarks on here, okay? But there's SOC1, where is it? Okay, there's SOC1, which is the report related to the internal control of financial reporting, okay? Now, this is probably the report that is issued by the service auditor, intended to be used by a user entity and user auditor in evaluating the impact of certain relevant controls that the service organization have on the financial statements of the of the entity that's being audited. That's, you know, the company that's using ADP. You know, we're looking at their financial statements and we have to do the internal control report. Okay. Now you come over, and if we're looking at SOC2 report, and the SOC2 report, okay, right here, is report on controls at a service organization relevant to security, availability, processing, integrity, confidentiality, or privacy. This report is issued by service auditor intended to give assurance to a broad range of users regarding the controls in place at the service organization. Okay, now go ahead and flashcard those two definitions. I think of the SOC1 and SOC2. I think I've given you, though, a sense of the SOC1 for our little example, but let's talk about SOC2 for a second. So let's say I'm a hospital and I have all of these patient records and whatnot, not what I used to be a housekeeper in the hospital. They would not give us a key to the medical records place. We had to go when the medical record staff were in there. We had to knock on the door, and then they would open the door for us. And that's when we would be able to go in and do whatever cleanup work we had to do. We could walk right into the surgery rooms, you know, but we couldn't walk into the medical record because the federal government, through HIPAA laws, says that information has to be protected. Well, you know, back in those days, you might have an office in a hospital where all that information was contained. It would be on these big, you know, rolling things that you turn the crank and the wall moves and you get, and they go and access the records. Well, these days, that's all automated, right? But as you can imagine, for a large hospital, that might take tons of computer storage space that they don't have the resources to maintain, and, you know, maintain security of that and everything. So what do? They outsource that. But they have to make sure that whoever they're outsourcing the maintenance of those medical records to has the proper security. They're in compliance with the HIPAA laws and all that sort of thing. So how do you get that assurance? You get an accountant to go in and do what? Do this SOC2 report and provide you with that level of assurance that indeed those security agreements and stuff or security requirements are being maintained. Okay, so it's two types of report. One deals with financial reporting. The other deals with, you know, security type issues. Okay, now you come over, and for each of these, SOC1 and SOC2, there can be a type 1 report and there can be a type 2 report. Okay, so for both of these, SOC1, and that gets a little confusing, but SOC1 sounds like a Jerry Seinfeld you know, thing. Oh, SOC1, why does SOC1? It has 2. Okay, so SOC1 has the type 1 report. Okay, and you could also have, where did I put my type 1? Oh, I see. That's where I wrote it. Okay. So there are two types. I drew it down too far. There are two types. There's a SOC1 can have a type 1 and a type 2 report. Okay. And SOC2 can have a type 1 and type 2 report. Okay, so all we have to understand now is the difference between type 1 and type 2, which are what? Both applicable to SOC1 and SOC2. Make sense? Okay, all right, good. So let's go and take a look, and let's take a look at type 1. And they tell us that the type 1 report is a report on the design and implementation of the service organization's controls. It does not provide assurance on the operating effectiveness. Flashcard that. So what happens? If you get a type 1 report as a user auditor, all that's going to cover is our first requirement that says on every audit we have to do what? Obtain an understanding of the internal control sufficient to evaluate the design of the control and determine that it's been implemented and make an assessment of the risk of material misstatement, in which case if we get this report, we're going to assess the risk of material misstatement at the maximum and do the full amount of substantive testing. So we could cover our first step, our obtaining an understanding part, our first step, our planning procedures. We would be able to do that, but then as far as our further audit procedures go, since the controls weren't tested, we'd have to do the full measure of substantive procedure. Okay. Now, if you come down and you take a look, and again, guys, we don't need to memorize reports here. And you look at the type 2 report. With the type 2 report, okay, a type 2 report is a report on the design, implementation, and operating effectiveness of the service organization controls. Flashcard that. So now they've also tested the controls. They've tested, the service auditor has tested the operating effectiveness of controls. So if we get that report, now we can use that as a basis for lowering our risk of material misstatement, and therefore what? Reducing the amount of substantive testing we're having. And I guarantee you that ADP, they get a type 2 report. There's no way in the world that they're going to be walking around the world without a type 2 report. I haven't seen it, but it's kind of like if I drop a hammer on a planet with a positive gravity, I need not see it hit the ground to know that it does. It's one of those kind of things. Okay, so that's it there. Okay, now you come over and let's take a look at some of the user auditors' responsibilities. Those are the ones that are getting the reports. And let's just take a look at it in the context of the now SOC1 and SOC2 report, which I've kind of already said this, but let's flashcard it here. A type 1 report may aid the user in obtaining an understanding of controls. However, a type 1 report is provided when tested operating effectiveness. The service organization controls were not performed, and therefore does not provide the user auditor with a basis for reducing the assessment of control risk below the maximum. Probably you're not going to be able to reduce the risk of material misstatement below the maximum, and you're going to do the full measure of your substantive testing. Okay. When we are talking about the type 2, SOC1 type 2 report, yeah. Now what? There's been a test of operating effectiveness, and the auditor could use that to what? To reduce the assessment of control risk below the maximum. Okay. So flashcard that, but I had already said that, but flashcard is there. Okay. Okay, good. Now let's see what happens now as we get these different types of reports, how it's going to affect our opinion on the financial statement. Okay, so the user auditor issues a qualified opinion or disclaimer of opinion if the user auditor is unable to obtain sufficient appropriate audit evidence regarding the services provided by the service organization relevant to the audit. The user auditor may not make reference to the service auditor report if it's unmodified. If you have had to do what? If you have had to modify or disclaim an opinion, then you would be able to go ahead and mention that as the reason for your disclaimer if there was some problem with the service auditor report. Flashcard that. You can use it to explain your modification, right? This is the reason we're qualifying, but you don't mention it. It's not a division of responsibility. You don't mention it if it's an unmodified opinion. Okay. Okay, good. Let's go ahead and let's take a look at this question. Okay. Stop, guys. I want to stop here because something's not right for me here. I don't understand what's going on here. So everyone thinks the answer is D. When an auditor plans to use an SOC 1 type 2 report, that's the report dealing with the financial statements, and that the testing of the operating effectiveness, the controls has occurred, right?
Mhm.
Okay. To reduce the assessed level of control risk for areas of the user entities accounting affected by the service organization, the user auditor should be satisfied regarding all of the following except, I see. I missed the except. That's why I'm at. So I did what I warned you guys not to do. All the following except a test of controls be determined where the service auditor are relevant to the assertions. Sure, right? If they're sitting there and we're going to have tested the controls, any relevant complementary controls have been designed and implemented, operating effectiveness has been evaluated. Yes. The service auditor is both competent and independent. Yes. So I see. The reperformance of the tested controls by the user auditor over the service auditor organization to verify. We don't know that they used what? We don't know that they used, you know, that would be silly. We wouldn't do a reperform. Well, what are we going to redo the audit? That's ridiculous, right? Okay. So the mistake that I made, guys, is I missed the except. The reason I got the question wrong is I missed the word except. And so, and I'm just kind of going through this quick, and I was like, oh yeah, you know, B is beautiful. Any relevant complementary controls have been designed and implemented and operated. I mean, when I saw that, I just fell in love with that choice, because that absolutely is something that's done. And I did it so fast, I missed the word except. That's why I thought it was B. So I don't want to say let that be a lesson to you, because when you're taking your exam, you're not going to be nearly as, you know, kind of quickly, you know, I have to admit, I've been looking at this stuff so long, sometimes like, yeah, get this out of my face, you know, and I just jumped down to that and I didn't read the question as carefully as you would on the exam. Okay, so the answer is D. You're right. You guys got it right. Okay, let's go ahead and take our break, and we will come back and we will start with module 6. I'm showing 6:25 more or less. So why don't we go ahead and return at 6:35? We'll take 10 minutes. I'm going to pause the recording, so just remind me to put it back when we come back. The recording. Okay. And what we're going to look at now is reporting on compliance. Fairly light set of material here now for the remainder of chapter 6 as we start looking at reporting on compliance, and we look at government audits. When we get to the government audits, there's going to be two things we're going to look at. I'm going to go through the text and pick out some things that you know, are useful for us, but the textbook kind of loses itself. And since I spent a little bit of time doing government audits, I thought it was okay if I went ahead and I give you a 3-page kind of summary of some key points that we'll take a look at that together too here as we wrap up class tonight. Okay. Now, when we talk about compliance, there's really 2 types of compliance engagements that we're looking at here. One is where we have audited the financial statements and we're asked to give some assurance on compliance with laws and regulations in connection with the audit of the financial statements. So we're going to look at that one first, but we could be asked to actually give an opinion on the entity's compliance, a positive assurance opinion on the entity's compliance. And maybe we haven't even with certain laws and regulations. and maybe we haven't even audited the financial statements. Okay, so when you audit financial statements, of course, you have to do what? Determine the financial statements are free of material misstatement. And one of the things you do look at is if there's material misstatement due to non-compliance with laws, but it's very narrow in what our focus is. Our focus is what those laws that could have a direct effect on the financial statement. So I think we gave the example in here. You would probably be expected to detect non-compliance with, say, filing a tax return because of the connection to financial statements, but maybe not non-compliance with, say, OSHA laws or something like that, because those are further removed from the financial statements. Well, here, what we're talking about is, yeah, you've audited the statements and the client is asked to go a little further and give negative assurance on the compliance. Okay, so that's what we're getting into here first. And you take a look, and they talk about compliance with the report on compliance reports in connection with the audit of the financial statements. My pen doesn't want to turn here for me. Compliance in connection with the audit of the financial statements. So the idea here is what? We've audited the financial statements, and now we're going to give some assurance around compliance with the financial statements. So you can see auditor, I don't know how often it is, the auditor is asked to issue a report on a client's compliance with contractual or regulatory requirements in connection with the audit of the financial statements. Okay, now the auditor must have audited the financial statements and may only give negative assurance on the compliance. And we talked a little bit about negative, flashcard that. We talked a little bit about negative assurance last time, but that's where the auditor says, I'm not aware of any problem, in this case, non-compliance. A positive assurance would say, in my opinion, they have, substantially been in compliance with laws and regulations, right? So this is a negative assurance. So flashcard that, okay? Now, what will allow us to give this negative assurance? And it's pretty easy. Negative assurance is the form of a statement that nothing came to the auditor's attention that caused the auditor to believe that the entity failed to comply with specific aspects of contractual agreement or regulatory requirement. And you can issue that if, no instances of non-compliance were identified. So just flashcard this whole thing right here, this statement, and then when you're able to give that. Okay, so the flashcard, I probably wrote the flashcard symbol in the wrong place. But the way you could do it is the blank side will say this, okay, and then the answer will be may be given, and of course, if no instances of non-compliance were identified, the auditor expressed an unmodified or qualified opinion of the financial statements. In other words, if you disclaimed or adversed, you cannot give this negative assurance. You could still issue the report and call out any non-compliance you found, but you would not be able to give a negative assurance if you had to give a disclaimer or qualified opinion, I should say disclaimer or adverse opinion on the financial statements, and the applicable covenants or regulatory requirements have been subject to audit procedures as part of the financial statement audit. So when you do that, then you would be able to give this negative assurance.
So quick question, would you do extra work if you were going to do the negative assurance, or would this just be, oh, when we were doing our financial statement audit, we didn't notice anything and we're telling you?
You would have to be, when you say extra work, I mean, you would have to, because they're asking us to give an additional assurance here. So I would think this part, there would have to be some part of your audit work that was subject to this. So if I was doing the audit work and there were aspects of laws that weren't subject to the audit work, I would probably expand that to cover those things. So maybe I might start looking more at those OSHA things, et cetera, in connection with the audit. So I would think you would have to go a little further so that it's not just things that you would discover as part and parcel of the audit of the financial statement. So that's a long way of saying yes to your question.
Okay,
The difference is it's not like because I'm doing this work, I have to have a larger sample size for checking compliance with these laws than I would otherwise, so it's kind of gray in terms of exactly how much work. It doesn't start to get quantified, out as to what it is exactly. There's probably no tables that talk to the sample size and level reliability for this assurance and all that kind of stuff like we would for our audit of the financial statements. So that's what I'm saying. It's probably a judgmental thing as to how much further you go, but I would think you'd want to be able to say, well, we expanded beyond just, those that have a direct effect. Maybe we looked at some indirect effect things too.
okay, and this would be like an additional thing in your engagement letter too, right?
Oh yeah, absolutely. Yeah.
Okay,
Yeah. Because, we're not going to just start issuing this because they verbally said to us, will you do this? And we're going to start asking for some representations from them as well. Okay. Okay, good. Now, if there are identified instances of noncompliance, when there are one or more identified instances of noncompliance, the report on compliance should describe the noncompliance. And again, if an adverse opinion or disclaimer of opinion is expressed on the financial statements, a report on compliance can only be issued if there were identified instances of noncompliance. So you can rat them out, but you can't give them the negative assurance if you've had an adverse or a disclaimer of opinion. Okay, good. The report on compliance should be in writing and may either be in a separate report or provided in one or more paragraph of the auditor's report on the financial statements. Okay. Now we get here and they start to talk about the attestation standards compliance attestation. Okay. And so when you're looking here, these address two types of engagements. Okay. So something seems off here. I guess they removed from the exam. In the old days, they used to test us on what goes into the compliance, the negative assurance compliance report, but I don't see it anymore. So just know that the report on compliance should be in writing. Of course, I mean, what are you going to do? Yell out the window? I mean, of course it has to be in writing, and it may either be separate or provided in one or more paragraphs of the financial statement audit. So flashcard that. Okay, all right, good. Let's come over and let's take a look at the attestation standards now. And now you're being called in and you're going to be called in to give an opinion on compliance with specific requirements and an entity's compliance with the requirements, laws and regulations, grants, and internal control. So you literally are giving opinion on internal control over compliance and compliance with specific requirements. Okay. Now you could do an agreed upon procedure. Okay. So this is now not necessarily, by the way, in connection with the audit of the financial statements. Okay. You maybe have an audit of the financial statements, but you're just being asked to give compliance. You're going to be asked to give an opinion. You could do an agreed upon procedure engagement. Okay. In an agreed upon procedure engagement on an entity's compliance with specific requirements or about the entity's internal control over compliance, the practitioner is required to perform only procedures that have been agreed to by the users. Remember, we talked about agreed upon procedures. The practitioner has no obligation to perform procedures beyond the agreed upon procedures. So flashcard that. And then they tell us, coming over to the next page, that we're going to look at the examination engagements. Okay, so this is where you're actually going to give the opinion about the compliance. Okay, so let's take a look. And a practitioner may perform an examination engagement related to an entity's compliance with specific requirements if the following conditions are met. And let's go ahead and flashcard that. Okay, and the responsible party accepts responsibility for the entity's compliance, the responsible party and the internal control over compliance. The responsible party here is management. Responsible party management evaluates the entity compliance, and sufficient evidential matter exists or could be developed to support what management has evaluated about their compliance. Okay, now let's just take a look, put that flashcard, but let's just take a look so that we understand that the objective of the practitioner examination procedures applied to the entity's compliance with specific requirements is to express an opinion on the entity's compliance based on specified criteria, and to express an opinion the practitioner accumulates sufficient evidence about the entity's compliance with specific requirements, thereby restricting attestation risk to an appropriate low level. Okay, so now we're giving an opinion, right? And you come over and they talk about materiality. And unlike in a financial statement audit where we said materiality has to be a dollar amount, that may not be possible when we're talking about contractual regulatory requirements. Okay, so in an examination of entity's compliance with specific requirements, the auditor's consideration of materiality is affected by the nature of the compliance requirement, which may or may not be quantifiable in monetary terms. Okay, so flashcard that, because I could see somebody trying to, say, oh, trick you into saying, oh, well, there has to be a monetary amount assessed with it because you're thinking that for financial statement materiality. No. Okay, now let's just take a look at what the overall requirements are. Okay, so we have to do what? We have to perform a risk assessment. We're literally going to assess the risk of inherent risk of noncompliance, the control risk of noncompliance, the risk of material noncompliance, and then the detection risk of noncompliance. Notice they put the what? The audit risk factors, and they just put the phrase of noncompliance behind that. Okay. We're going to have to respond to the risk assessment, determine if supplementary audit requirements exist, obtain written representation letter from management, prepare reports, and then, did I say repair reports? Prepare reports, and then, of course, prepare the required documentation, flashcard those requirements. And then let's just take a look at the required documentation. I think I've been pretty consistent in asking you to always flashcard documentation requirements. So what was the assessed risk of material misstatement, material noncompliance, excuse me, include the procedures you perform and documentation of the internal control, our narratives, our flow charts, etc. Response, how did you respond? What procedures did you do to test the compliance? What procedures did you do to test the controls? Because we're giving an opinion on the controls as well. The basis for the rationale for materiality levels, and then compliance with any supplemental requirements. Okay. Now you come over, and since we have to get a representation letter, let's go ahead and let's flashcard what the representation letter elements are going to be, because they're going to be telling us, hey, we were in compliance and we checked everything. So what happens? The responsible party management, which includes the following statements. Management takes responsibility for complying. Management takes responsibility for establishing and maintaining effective controls. Managers perform their own evaluation of the entity's compliance and the entity's controls over noncompliance. Management has disclosed if there is noncompliance. They've made available all documents related to compliance. Management's interpretation of any compliance that they have that may have varying interpretations. Management has disclosed communications from regulatory entities, internal auditors, and they have disclosed known non-compliance to us. Okay, so flashcard, that is typical representation letter, language there. Come over, and we have the attestation risk of non-compliance. So that's like the audit risk of non-compliance, okay? And it is made up of the risk of non-compliance and the risk of material non-compliance, and that is made up of what? The inherent risk, and I always feel like there should be that little voice, you know, you watch a commercial and then they dub in, we will be in San Francisco next week, and it's just a generic commercial, and they just kind of like threw in some voice, different voice comes in. We will be in San Jose, and they put the voice in there. Okay, so I feel like they should put in a voice that says the risk of material non-compliance, right? Because they're just borrowing from the the standard. Did a good job really of connecting these terms to financial statement audit terms, right? So instead of saying the risk of material misstatement, they say the risk of material non-compliance, and that's made up of the inherent risk of non-compliance and the what? And the control risk of non-compliance, right? Okay, and then we have the detection risk of non-compliance, okay? Now you come over and we have those two, inherent risk of non-compliance, right? And we have over here, what? Control risk of non-compliance, right? Okay, so they just put the word of non-compliance next to, the phrase inherent risk and control risk, okay? And then we have the detection risk of non-compliance, which is the chance that the auditor's procedures will not detect the non-compliance, okay? So basically, you're going to assess the risk of non-compliance. Of course, it'll never be zero, and you're going to respond to that assessment by what? By then going and doing procedures that'll help you detect the non-compliance. Okay, all right, good. So let's go ahead and let's take a look at this question. Okay, guys, let's take a look at this one. most of us got it right, so we got a good turnout here. A couple of us wanted to pick A, but let's just go ahead and take a look. And they're telling us that when an auditor is asked to issue a report on a client's compliance with contractual agreements or regulatory requirements in connection with the financial statement audit. So that means what? That means we're going to give negative assurance. It means that we have to have audited the financial statements of the entity. And it means that what? We must have given a qualified or better opinion. We can't have given an adverse or a disclaimer of opinion, right? Wasn't that sort of the requirements here? Okay. So the auditor must have expressed an unmodified opinion on the financial statements and may only issue negative assurance. Well, it's true that we can only issue negative assurance, but we don't have to give unmodified. We could have qualified. What we can't have done is what? Disclaimed or adverse, right? Okay. The auditor must have audited the financial statements and may only issue negative assurance. Yeah. Okay. And I don't think anybody wanted these other ones. Question? Okay, good. Let's move into module 7 now. Let's start to take a look at government audits. Okay. And as I said, we're going to go through, I'm going to, point out some things that are helpful in the book, but then I'm going to turn to that sort of 3-pager that I have that I think kind of is a little easier to digest than the way they've sort of rambled through some of this. Not, I don't know about rambled, but they have meandered through some of this that I think that 3-pager kind of pulls it together a little better. So anyway, but let's go ahead and take a look. And we have gas and GAGIS are the source of standards for government audits. Okay, so GAS, generally accepted auditing standards, and GAGIS, generally accepted government auditing standards, aka the yellow book, are the standards that are used when you're doing an audit of a government entity. For example, I was involved in audits, financial statement audits of federal agencies. And when you do an audit of a federal agency, they tell us we have to do the audit in accordance with generally accepted government auditing standards, the yellow book, and we put that in our opinion. We conduct our audit in accordance with GAGIS. But when you look at the yellow book, now you see why they call it the yellow book. See how skinny it is? See how thin it is? Okay, now why is it thin? Because government auditors have to get home at 4:30. We can't be doing all that work. No. What happens? This book points to all the other standards and then adds on some things, adds on these things. Okay, so when you do the audit, even though you say in your report, we follow generally accepted government auditing standards, GAGIS, that's really saying we follow both GAGIS and GAS, and we added some things on. So when we look at this, we're going to be focusing on what things additional are in this little book, okay, versus what? Versus the whole, if I held up all the auditing standards, it'd be 2 big volumes, right, of all the auditing standards. What gets added on when you do it with this book? Now, the book has grown. This is what it was around the time I started. Okay, now it's getting a little bigger, so it used to be a lot skinnier back in the old days. Okay, all right. These days, I don't even think you can get one of those anymore. So I should probably, try to sell it on the street corner or something, because nowadays you would, of course, get it online and it may not look yellow anymore. They turned it to the yellow book because somebody said at one point, said this is going to be the gold standard of auditing standards, and then somebody said, well, maybe we better just go with yellow. So that's the reason the thing is yellow. So okay, all right, good. So let's just come over and let's take a look, and we're going to really focus on the financial statement audit aspects of that's contained in the yellow book. But if you look at the organization of the yellow book, it also provides information about how to do something called performance audits. So performance audits are the things that I did at the back end of my career that you hear me talk about sometime, like looking at HUD and seeing how good of a job they're managing, housing agencies. Abby, are you trying to talk to us? I don't know if she's trying to talk to us or hearing us, or I don't know.
I think she has a kid that's in the room that's asking her questions,
Oh,
because he's
okay.
gone in and out of the
Okay.
background.
Okay. Oh, okay. I see. Because I thought maybe she was saying something. Okay. I just wanted to let you know if you were trying to talk to her. Okay, good. Now, let's take a look. And one of the things that when you do government audits is you develop something called findings. Okay. And when you develop a finding, in order to have a finding, you have to have criteria, what is supposed to be, the law, whatever it is, the condition, what is, and obviously if they're in compliance with the condition, we wouldn't be talking about it. So the condition means they're outside of the criteria. Why are they outside of the criteria? What is the effect of being or potential effect of being outside of the criteria? When you have all these things, that generally equals a recommendation. Okay, now this stuff is more relevant right here to the program audits. Okay, good. Now you come over and they talk to us on the next page a little bit about communication. So in addition to the AICPA requirements for auditor communication, auditors should communicate pertinent information in the auditor's professional judgment needed to communicate to individuals contracting or requesting the audit to cognizant legislative committees. Okay, so you may need to consider that. That guidance is more directed towards organizations like GAO. Okay, when they're saying that, they're saying, look, you need to make sure that you have gotten your information to the appropriate legislative committee. But the reality is that you get a requester. In the old days, we used to do what they called self-initiated work. So I could be sitting there one day and say, you know, I'm concerned about this issue, and get the approval internally to go ahead and start looking at that issue. These days, most work is requested by the congressional committee, and the committee that requested it is the one that you will issue that report to. But once it's issued, and other legislators becomes a public report, and other issuers, other committees and stuff could sit there and look at that report. But sometimes you might go around and shop it around to other committees that might be interested in that work. So you could do that. Okay, now we take a look and let's really focus here where the, I think where you might get some questions. Okay, so we have this, we're talking about financial statement now, financial statement auditing now. Okay, so the yellow book is organized performance, financial statement audit. And what are the reports for financial statement audit? And I said the book is thin, but it's pointing to all the other standards. So if it's pointing to gas, do we have to give an opinion on the financial statements? If you do an audit according to gas, do you have to give an opinion on the financial statements? Come on, guys, we've been talking about that now over and over, right? Okay, so there will be what? There will be an opinion on the financial statements. Okay, but you will also give a report on the work that you did with the internal control, and you will give a report on the work you did for compliance. Okay, now let me ask you something. Do you have to do work on internal control under gas?
No.
You have to understand it. You have to do enough to understand it and make determinations.
Was that work?
Yeah.
Okay.
Yeah.
So you have to do some work on the internal control. Do you have to issue a report on that work?
No.
No, you don't have to. So we need what? We need a thin book that tells you, you know, we're going to add on to what you do in gas. You still do all the stuff that gas says, but we're going to ask you to issue a report. Now, the report is not an opinion. It is not an opinion like you get under Sarbanes-Oxley. It is a what? Report describing the scope of the work that we did, etc. It's a report, it's a written report, but it's not an opinion. It's published with the financial statements. It's publicly available, but it is not an opinion. It doesn't draw conclusions to the effectiveness of internal control. It just describes the scope of the work that we did. And if we found some weaknesses, we'll call those out, but it's not an opinion on the effectiveness. Now, my belief is that the yellow book is not asking for this because they lack courage. Okay. If they had to do this, if they had to give an opinion, then they would be going all over the place issuing adverse opinions about the effectiveness of internal controls in government entities. And they don't want to do that. So the yellow book isn't going to require it. Now, what's interesting is the agency can request that. The agency can request the opinion, and for some weird reason, the Department of Defense asked for that. And I can't figure out why they wanted that, because they were skewered for all of the problems that they have with their internal control as a result of getting the opinion. But anyway, it's not required. They can request it, but it's not required. So the report on internal control, okay, and we say that when providing GAGIS also includes a number of requirements for reporting on the financial statements in addition to the GAS standards. So we have to give an opinion under GAS. We can take a look that when providing an opinion or a disclaimer on financial statements, auditors should also report on internal control over financial reporting on compliance with provision of laws and regulations. And the way they phrase that makes it sound like what? Makes it sound like it's an opinion. It is not. It is a report. It's not an opinion. Okay, so just make sure you put that, not an opinion.
Now, do these reports contain findings?
They will contain, they are to be issued regardless of whether there are internal control deficiencies, but they would call out the deficiencies. So auditors should include the same or separate report description of the scope of the auditor's testing of internal control and compliance with laws. And if there are weaknesses, Kathy, yes, they should be called out. So if you want to call that a finding, then they should be included.
Okay.
So you would have to call out significant deficiencies and material weaknesses. Okay. Okay, good. This is a little bit, and this is what I'm talking about, guys, that they remember I said they meander. I don't know why they're saying this here. This would have been more appropriate probably in the discussion of the condition, criteria, cause and effect, and the findings, and that are more terms associated with a performance audit. The yellow book says you have to let the views of the responsible officials, you have to give them their day in court. So what happens is you write the report, you have these findings, and you send it over for agency comment, and the agency then comments. They argue with you as to why they think this happened, or sometimes they just agree and they start to talk about, different actions they'll take. Typically they argue though, and then you write a response to their comment. So you get agency comment and then you go ahead and go back. But usually the agency comment, not that it's relevant for our test here, but I tell you, sometimes I have audit flashbacks, but sometimes, these agency comments are the same shit you've heard from them from when you first started telling them they're doing something wrong. And so it's no surprise that they're giving, okay, here they go again. And we've told you, you don't say that in your response. We've told you that that's not a legitimate reason to not do what we're asking you to do. Okay, so they always want to, like when I was telling them that they should do, HUD should do some procedures that are specific to risks that they have. When they get the audited financial statements of a housing agency, there are specific analytical procedures that they should do that are consistent with problems that housing agencies often have. Instead, what they do is they do a set of analytical procedures that are listed in any book on analytical procedures. They do the current ratio. They sit there and they do, you know, the debt to equity ratio. And I'm like, well, that was already done by the auditors. You have a set of audited financial statements. If there was something significant there, the auditors would have caught it. You need to do things that are more consistent with your job to monitor what? To monitor the operation of the entity. That's the analytical procedures you should be doing. Well, we do, you know, you tell them all that and they say, but we do analytical procedures. I know you do, but you do that, your procedures are redundant to what the auditors did. So, you know, so when we issue the report, they once again say, we do analytical procedures. Okay. Okay, good. Now, what I want to do is stop the discussion here of the government, what they're calling government, and we're going to pick up here in a couple seconds, okay, the discussion of, oh no, wait a minute. I do want this though. Let's flashcard this right here. This I do want. Okay, the written representations. Okay, written representations from management. And gas guidance with respect to client representations include the following. They need to give you representation. There are no violations of laws, okay, which would affect the financial statements. Management is responsible for the entity's compliance. Management has identified and disclosed in writing to the auditor all the laws and regulations that are relevant. I mean, they should know, right? Okay, so flashcard that. Here you go, Kathy. The auditor should report all significant material weaknesses and deficiencies in internal control. Okay, so, you know, if you're just doing a straight gas audit, those are reported internally only, right? This is written in an external published report that you have to call those out. Okay. Okay, good. Now you come down and let's look at this question 1. And then I'm going to take you to that summary page, and then we'll look at the book, and then I'm going to come back to the summary page. But let's just go ahead and look at this question. Oh, before you get too far off into this question, when I look at these questions, and maybe it's because I've had too many years of experience with this, I look and I'm like, the other 3 choices are laughable. If one of the choices sounds like fun, interesting, exciting work, it's wrong. Okay. It should sound like the answer should be, God, I hope I don't end up doing that for the rest of my life. That's usually the correct answer. Okay, so with that little bit of guidance, let's go ahead and look at this question. Okay, guys, we're going a little overtime here on this question. Oh, I guess that's because I talked through some of it. I'll give you a little more time. Okay, let's go ahead and look at this one. I'm going to end the poll. And good, we had a pretty good result. A couple of folks wanted A. I have no idea why. Which of the following is applicable to financial statement audit in accordance with the government auditing standards? An auditor should assess whether an entity has reasonable measures of economy and efficiency that are valid and reliable. Please show me where we said anything near that. I'm not sure why we would even think that that would be a possible correct answer. I don't think we said anything, even in the ballpark of that. So no, I mean, first of all, that would be, a difficult audit if it was requested by Congress specifically to go look at that. And we certainly aren't going to just, ship that out as part of an audit of the financial statements. I mean, come on, that's not going to happen. Okay, so, okay, let's take a look at B. The auditor should report on the scope of the auditor's testing of the internal controls. Yeah, assuming you did test them. This was an argument that I used to have internally at GAO all the time, is they would say, we have to test the controls because we have to issue the report on internal control. And I'd be like, no, you do not have to test ineffective controls. If I look at the design and the implementation and they blew it on those, I don't have to test an ineffective control. I'll have to assess whether that constitutes a significant deficiency or a material weakness, and I'll have to call that out in the report, but I don't have to test the controls to determine that. Now, I may test the controls, and if I do, then of course I would describe the level of testing. And if I find significant deficiencies and material weaknesses, I would have to call that out. But there's nothing in the yellow books that says you must test the controls. So, you would certainly, if you did test them, describe the scope of that testing. An auditor should briefly describe the report, the method of statistical sampling used in performing tested controls and substantive tests. The problem there is the yellow book doesn't say you have to use statistical sampling, and neither does gas. So you don't have to use statistical sampling. You may use it and you may describe that, but you don't have to use it. Okay. An auditor should determine the extent to which the entity's programs achieve the desired level of results. Well, that sounds like fun, but that's not something that is even really talked about in the yellow book. Okay, so just so that we're understanding the reporting structure here. Okay. And what I have is this little graphic that I had, oh, really? Okay, there it is. That I had suggested at for a CPE class that I was doing for Becker. So Becker had tapped me to do government CPE classes. And so I figured it was okay, since I kind of, put this class together, that it was okay for me to go ahead and use this for this particular class. Okay, so when you look at this, when you do government audits, you have to have 24 units of continuing professional education that are dedicated to government subject matter. And so Becker had tapped me some years back to do a series of classes. I think I did like maybe 15 classes that were relevant to government audits, so that people could meet the requirements for 24 CPE. The thing that was irritating is, after I worked with another guy to develop all the classes, then as the classes shelf life started to expire, then they started pulling in people with beautiful heads of hair to teach those classes. So it's like, oh, okay, now that you got all the stuff, now you're going to bring in the movie stars to, do this. So that was a little irritating, but whatever. I was tired of it anyway. Now, so what happens? So what I did was I tried to show you here how this stacks, how the reports stack as you move from what gas requires, what you can see here is what at the bottom is an inverted pyramid here at the bottom. That's the opinion on the financial statements, right? GAS requires it, but GAGAS requires it because GAGAS points to GAS, doesn't it? Okay. And then under GAS, they require not an opinion, but what? A report on the entity's internal controls and a report on compliance with laws and regulations. We do that work under GAS, but GAGAS says we want you to issue a report on that subject matter. It's not an opinion, but it's a report. So now we've got what? Now we've got 3 reports if you're doing the audit according to GAGAS, right? So when you audit IRS, you got to issue those 3 reports. Okay. Now this thing is going to continue to build, and we're going to add 4 more reports that are required under the Single Audit Act. So let's just go back and let's take a look at single audits. Okay. And under the single audit requirements, now I'm going to go back to the textbook. Under single audit, here's what happens. When you're auditing a federal agency, got to follow the yellow book, got to have the 3 reports, right? But what happened? The federal government dispenses, trillions of dollars to various entities, state governments, local governments, cities, counties, not-for-profit organizations. So the federal government is distributing all this money. And if you're a not-for-profit, you're a city, a state, you may receive funding from several different agencies. You may get some money from HUD, you may get some money from Department of Justice, you may get some money from whoever, right? All these different federal agencies are going to give you money. The Department of Education is going to give you money. Well, in the olden days, I think it was like around before 1984, when the Single Audit Act was issued. Before then, what happened is you would be inundated with auditors from all these different agencies knocking at your door saying, we're going to come and audit compliance with our requirements. So it started to become overly burdensome. So in 1984, Congress passed the Single Audit Act. And as it implies, single audit says, you know what? We're going to have one auditor, and the one auditor is going to come and they're going to look at the compliance with all the programs. And all of the, recipients of federal financial assistance said, thank you, God. Now, it's a little irritating is agencies will always whine that they don't get the visibility that they need to of their programs because of the Single Audit Act, and they still want to go and do their individual program audits. And I'm always like, it's because you're not using it right. You're not using the single audits correctly. That's why they're not effective for you. What you should be doing is analyzing the single audit reports that are relevant to your program, summarizing the kinds of problems that the single audits are finding, and then put controls in place that address the common issues that you have. You can use this work to, to improve your management of your program and not sit there and whine about how you feel you don't have enough visibility. But anyway, enough of that. So they call it a single audit. And they said, yeah, one auditor is going to come down. You could be receiving money from 10 different federal agencies, but one auditor will audit your compliance with all of those different programs. Now, that was good for the recipients, but the Single Audit Act said, wait a minute, before you celebrate too much, we're going to require that you have an audit of your financial statements. If you're not already, you will get an audit of your financial statements, and you'll have those audits done according to the yellow book. So now, if I'm receiving federal financial assistance for my financial statement audit, I have to have the opinion, which would be the case anyway, even if they were getting audit gas, but they also have to have what? The report on internal control and the report on compliance, don't they? And then the Single Audit Act, as you kind of saw across the top of that inverted pyramid, is going to add 4 more reports onto that. So we're going to end up with 7 reporting elements by the time we're done here dealing with the single audit. Okay. So when you come down, when you get an audit under the single audit recipients of federal financial assistance should be conducted in accordance with both what? both the gas and GAGAS requirements. Okay. Now, under the Single Audit Act, if you receive amount in excess of 750,000, then you will have to have this Single Audit Act. So they take off some of the burden of the audit for entities that are receiving amounts below this dollar threshold. Okay, and I don't think the exam is going to test you on that number. I'm not going to have you flashcard that. Okay. Now, when you look, the single audit has two main objectives: audit of the entity's financial statement, okay, and an audit on a schedule of expenditures of federal awards. And I'm always like, this had to be a bureaucrat who thought of the name of this schedule, a schedule of expenditures of federal awards. They put two ofs in there. So this is like a new financial statement, and we will have to get an opinion on that. And then there will be a compliance audit on the major programs and on internal control over compliance. So what are we talking about here? Let's say I'm a not-for-profit, and I get my not-for-profit is here. I get some money from the federal government, enough to qualify me to have the single audit. And I get some money from, my program is helping at-risk youth, let's say. And I get some money from Department of Education, right? Because I'm educating at-risk, at-risk youth. I get some money from Department of Labor, because maybe I'm doing some job training in there. And I get some money from Department of Justice because, hey, you're keeping folks out of trouble, right? Okay, so let's say I'm getting those different amounts. Well, what I would have to do is, as the auditor, I would have to look to see that they were in compliance with those program requirements. So if the program said nobody over the age of 18 should be involved in this program, well, I would have to do some testing to ensure that there was no one over the age of 18 involved in that program, right? And if there was, I'd have to call out that as a finding on something called a schedule of findings in question cost. But I would also be required to look to see that the entity had internal controls over that compliance. So I would have to look to see I call it the agency, the not-for-profit. I would have to look to see, hey, do you require a birth certificate to be presented so that we know when someone joins the program, so we know that they're not over 18? They'd say yes, and then we would probably test that control, and we would say, can we please see the birth certificates, right? Okay. Now, this is an area that is typically we'll use sampling, right? We'll pull so many participants and look at their birth certificate, and therefore we'll be able to see their date of birth, do purpose testing, and we'll be able to do that, right? I'm of the opinion that this is an area that data analytics could allow us to do 100% testing. Because what you would do is you do a query that would sit there and say, what are the dates of birth of all the individuals that are participating in this system? You do 100% testing, right? If it's before a certain date, right? Then that means that they had individuals that were, over 18. And then I would imagine you could probably even do some sort of, artificial intelligence that would then look to see that there is something in the birth certificates that are on file, right? There'd be some sort of electronic file there that could look to see that the date of birth matches what the date of birth is that's in the system for that individual, right? And so I don't understand why this is an area that for these kinds of audits that they haven't more leveraged data analytics software. So I keep saying that, and I keep mentioning that. And I was just mentioning it the other day to one of my students at Stanford, and I was telling him, hey, dude, invent something, and then all I ask for is a Lamborghini after, you use my idea to develop this. So I think there's some opportunity there for using the data analytics. So you would have to do what? You would have to not only look at the compliance, but you'd also have to look at what? the internal control over compliance. Okay, now the compliance report is an opinion. The internal control over compliance is a report. Okay, so we have the opinion on the financial statements, the opinion on the schedule of federal awards, the opinion on compliance, and then we have the report on the internal control over compliance. That's those 4 additional reports that are across the top. Now, just to give you a visual of the schedule of expenditure of federal awards, all it is you'd say, okay, we got some money in our little example from Department of Labor, Department of Energy, and what did I say? Department of Education, and what did I say? Department of Justice, let's say. Okay, and you would just list, and you provide some identifying information, something called a CFDA number, Associated Catalog of Federal Domestic Assistance on that schedule. And then you would just show the amounts that they expended under those. So it's like a new, and I'm just making these numbers up, obviously. So it's like a new financial statement, essentially. The auditor gives an opinion on the fair presentation of that information. They give an opinion, of course, on the financial statements, and they will give an opinion on the compliance, and they give a report on the internal control over compliance. Okay, now you come over and note that the Single Audit Act requires that materiality of a transaction or other compliance finding be considered separately in relation to each major program, not the financial statements taken as a whole. And there's a whole algorithm as how you determine a major program, but know that the materiality is what is much more granular. You look at each program that they're receiving, major program that they're receiving funding over, in making your decision as to which programs you're going to subject to this compliance auditing. Okay, come over to the next page, and if an entity wants to, they could ask for a program-specific audit rather than the single audit. And that's probably, for entities that are maybe receiving money from only one entity, only one federal agency, and so they just decide to go ahead and ask for a program-specific audit because they're just getting money under one program. Okay, all right, good. Let's go ahead and let's take a look at this question. Okay, looks like most of us had a chance to try this question. So let's go ahead, and I'm going to end the poll, and let's take a look at how we did. And good, a couple folks wanted A, and that's the exact opposite of what we said. we said that what? So maybe that was bouncing around in your head somewhere. We said that what in a single audit, the auditor's consideration of materiality differs from materiality under generally accepted auditing standards. And if it differs, then under generally accepted auditing standards, then A cannot possibly be the answer, because under generally accepted auditing standards, we calculate materiality in relation to the financial statement taken as a whole. So it's wrong for that reason. Plus, it's wrong in that we specifically said that's not the case in single audit. Their materiality is determined what? Separately for each major federal financial assistance program. By the way, guys, government auditing, probably 3 points on the exam. Okay, so you're not going to get 52 questions of this nature, but I had you flashcard that. Okay, then we come through and we go through and we start to give some additional detail here about the single audit. And at some point, this thing just dances itself off the stage. And at some point, to be honest with you, it starts becoming factually incorrect, because they sit here and they say in this pass key that there are 5 reports issued. And to be honest with you, I don't know what the hell they're talking about. What are the GAGIS Yellow Book reports, and why are they counting that as 1? When there is going to be what? There's a report on compliance and report on internal control. So I guess they're counting that as 1. I guess the reason they're coming up with 5, but that is confusing. And then it's even more confusing when they turn around and they give you this supposedly helpful, handy dandy little table over here. And then all of a sudden there's 7 things being checked off. So it's like, well, is it 5 or is it 7? Okay, so what I'm going to do is stop with that, and I'm going to take you over here. Okay, and I think I'll start at the bottom here. Okay, so what happens if you are subject to the Single Audit Act? And by the way, it's no longer Circular A-133. I should probably cross that out. If you are subject to the Single Audit Act, okay, you get what? You get the GAS report, right? Because GAGIS points to GAT. You're going to be audited by the Yellow Book. Your financial statements are going to be audited by the Yellow Book. GAS points to GAGIS. So you have to issue the GAS opinion and then the 2 reports on internal control, the report on compliance with laws and regulations. So we got 3, right? Then, as we saw earlier that I was talking to you about, the Single Audit Act adds 4 more reports on top of that. So we have what? We have the report on the schedule of expenditure of federal awards. That was that where we listed Department of Labor, Department of Justice, Department of Education, and I put the dollar amounts next to them. Okay, you have to get an opinion on that. Then there is a report on internal control relevant to the programs. Again, did they have some control in place so that only kids under a certain age participated in the program? So they asked for the birth certificate as the control, right? Then there's an opinion, okay, on compliance. It's an opinion on compliance. You will state that they were substantially in compliance with the program requirements. And then there's this 7th report called a report on schedule of findings and question cost. And basically what you're saying is, hey, here's what my findings were of non-compliance. If there's any question cost, money we think they need to return to the government because they spent it inappropriately, you put that in that final report. It's not an opinion, it's a listing of findings. If there are no findings, you just issue that report and you say none, but you have to have something that addresses that. So there's 7 reporting elements, okay? So what I'm going to do here now is I'm going to read through this with you. And sometimes students say, well, don't read it. And I'm saying, I'm not reading, I'm talking to you because I wrote this. So it's not reading, okay? So let's just take a look and let's read through this, okay? So, and by the way, guys, this is on e-learning, so you can pick it up afterward. Don't go looking for it now if you don't have it. Generally accepted government auditing standards, GAGAS, the Yellow Book, okay, are promulgated by the Government Accountability Office, GAO. So not only have I done audits according to this book, but the agency I work for wrote the book. There was always this woman who she called herself, this lady, for a co-worker at GAO, always called herself the guardian of the Yellow Book. I was like, oh, please get over yourself. Okay. But anyway, they have that part of the work is done. But GAGAS covers both financial and performance audits, right? And we pointed that out. Performance audit review issues such as effectiveness, economy, and efficiency of various federal programs. GAGAS financial statement audits are typically applicable to the following entities: federal agencies, for example, IRS, and recipients of federal financial assistance here, item B, for example, state and local governments, not-for-profit organizations, okay? Now, some things that I've asked you to flashcard here that I don't know if they were mentioned in the book, and I don't care, but I know that you might get, somebody might ask you this on the exam, so I want you to flashcard this. Okay, so this Roman 3. Audit firms that perform GAGAS audits must receive a peer review, and the peer review needs to be made publicly available. Flashcard that. GAGAS financial statement audits incorporate GAS. Therefore, GAGAS audits require the auditor to provide, one, an opinion on the entity's financial statements, but GAGAS adds for financial statement audits 2 additional reports on internal control and report on compliance and laws and regulations. And so I tell you here, flashcard the 3 reports required by GAGAS, the opinion and the 2 others. So now you've got the 3 reports there, right? Okay. Now let's dig in a little bit more of the reporting on the internal control. GAS, like GAGAS, requires the auditor to obtain an understanding of the internal control sufficient to evaluate the design of the control and determine that the controls have been implemented and make an assessment of control risk, right out of our language from some of our earlier discussion of internal control. However, GAGAS also requires the auditor to prepare a written report on the auditor's understanding of internal control and the assessment of control risk on all audits. GAGAS also requires a description of the auditor's work on internal control, a description of deficiencies in internal control, and communication of all significant deficiencies and material weaknesses. You can flashcard practically this whole page, but you can see that this is picking up some of the key elements that we saw, okay, and just kind of putting it all in a 3-page summary here. Auditor's responsibility when reporting on compliance with laws and regulations and provision of contract agreements. GAGAS requires auditors to provide reasonable assurance that financial statements are free of material misstatement resulting from violation of the laws and regulations that have a direct and material effect, right? We've talked about that. And a report on, we have to report on all instances of fraud and illegal acts unless clearly inconsequential and significant violations of provision of contracts or grant agreements. Management's responsibility, and I think I might have asked you to flashcard this in the book as well. Management is responsible for identifying applicable laws and regulations, establishing the internal control over compliance, obtaining an audit that satisfies relevant regulatory requirements. That's the Single Audit Act that we'll talk about in a minute, and responsible for the preparation of the schedule of expenditure of federal awards. So let's look at the single audit. Okay, and again, we saw in the book, entities that expend a total federal financial assistance in excess of $750,000 must receive an audit in accordance with the Single Audit Act. An audit of this includes an audit of the entity's financial statements following GAGAS. That means that a not-for-profit receiving federal financial assistance, we receive what? The report on internal control and the report on compliance discussed above for the GAGAS financial statement audit requirements, and the opinion. There's 3 reports. Additional reports or reporting elements required by the single audit are report on internal control over compliance. That's the report that talks about, did they look at the birth certificate? And 5, an opinion on compliance with requirements applicable to each major program. And that actually is an opinion. Okay. Now, when you do the compliance audit, guys, and I'm not going to go back through this, but when you do the compliance audit, part of the audit, we looked at guidance for compliance audits, didn't we? Where we talked about assessing the risk of material noncompliance. We had the inherent risk of noncompliance, the control risk of noncompliance, the detection risk of noncompliance. So when you go to do that compliance audit, the AICPA has given us what? Guidance under the attestation standards is how to proceed there. Okay.
I have a question.
Mhm.
There's two in a single audit act thing, there's 2 compliance audits. There appears to be one on the entity's compliance with laws and regulation, and then there's also one on major programs. I think I'm not quite sure about the distinction between those 2. Wouldn't there be some overlap?
Well, there probably could be some overlap, but I don't know, I'll get into that. But compliance discussed above, this compliance is this one. They say compliance discussed above in item 4. So when you go to item 4 right here, that's this report on compliance with laws and regulations in connection with the audit of the financial statements.
Okay.
So when I do an audit according to GAS, I have a expectation that I would detect misstatement that is caused by direct non-compliance that has a direct effect on the financial statements, right?
Yeah.
So if the entity didn't file their tax return, they're not in compliance with laws, I should have found that, right?
Right.
It's like a not-for-profit. Not-for-profit should follow, should issue a not issue, but what do you call it when you submit your tax return?
They have an informational return they have to submit.
Yeah, but what do you call it? Should
I forget.
file
Right, you file it, right.
a form 990. It's an informational return with the IRS, right? And it has a bunch of reporting elements, the names of directors and all this kind of stuff, right? Okay, so they have to issue that. Well, look, I should probably, if I'm doing an audit of a not-for-profit, I should probably catch that if they don't file that, because there's probably certain things I might be asking for there that'll help me with the audit, right? Whether or not they're in compliance with, safety, occupational safety laws, which they should be, but I may not catch that in connection with my audit, right?
Right.
Okay, so when you're doing an audit of a not-for-profit that received federal financial assistance, it's according to the yellow book. The yellow book says, do everything you do with GAS as it relates to compliance, but you're going to have to issue a report on that work. It's not an opinion. You're going to have to report out what you did. You might do some very similar things that you do in a financial statement audit in relation to compliance that have a direct effect, but there's no reporting requirement around that under GAS. GAGAS is saying, no, we're going to make you issue a report that describes the scope of the work and any non-compliance you found in that area. Okay, but it's not an opinion.
Okay.
When we get to the Single Audit Act said, we're going to have one auditor come down and they're going to check your compliance with major programs. And we're going to end up with an opinion as to whether or not you are in compliance with the requirements of those major programs.
Okay.
So now we're getting down and we're saying, okay, you had in a program that you received funding from Department of Education to help at-risk youth. And that program says nobody over the age of 18 can participate in this program. So the auditor should test specifically for that to see if there was anyone over the age of 18 or 18 or over that participated in that program. And that's what I was saying.
So it's really by the major programs. It's like this program and that program and another program.
And the compliance requirements specific to those
To
programs.
each of those.
Yeah, no one over 18. That's why I was saying you could use data analytics for this kind of crap. I mean, it's very, narrow. I mean, God made computers to look at these very narrow parameters of things, right? And so you could design, I'm sure, an auditing software that'll go in and look at every single record and tell you if there's anyone in there over 18. And you could do the control testing because computers can read now documents and look, and you can tell it to look to the birth certificate to see the date of birth on the birth certificate. And, do 100% testing on the controls as well. Okay, but you got to do that kind of work.
Okay, thank you. I was just getting confused.
Yeah, so just think of it this way. One's not an opinion. The report on the internal control connected with the financial statement audit is not an opinion. The compliance discussion, not internal control is not an opinion. The report on compliance is what we're talking about, is not an opinion. This one that's right here on the screen right now, right here. Okay, this one down here is what is an actual opinion on the compliance. Okay, and since you're giving an opinion on the compliance, we're bringing in that statement on attestation standards discussion here that tells you how you can structure your work to give an opinion on compliance. We already talked about that under the attestation standards, right? So I'm just bringing that here to show you that that's how you can do that, make that evaluation. Then an opinion on the supplementary schedule of expenditure of federal awards. That's where they laid out, the Department of Labor gave this much, Department of Education gave that much, Department of Justice gave that much. I drew that little thing for you. And then a schedule of finding and question costs. So I tell you, Flashcard, and I'm calling it 7 reports. Now you can combine some of these reports, and that's why I think they said 5. But it's more important for you to realize that there are 7 reporting elements, because an entity could issue these reports combined or separate. For example, they often issue the reports on compliance and internal control over compliance together in one report. The report on the opinion on compliance with each major program and the report on internal control as a combined. So that's where I think they got 5, but it's really 7 reporting elements. The opinion on the financial statements, the report on internal control over financial reporting, report on compliance with laws and regulations in connection with the financial statement audit. Then we get into the single audit ones, a report on internal control over compliance, a report on compliance with each major program. And that is, I should probably be consistent here, that is an opinion. Okay, and then an opinion on the schedule of the expenditure of federal awards, and then the schedule of finding and question costs. And I also tell you to see the chart, which we've already gone through. I don't think we need to repeat that now. Okay. Question. Okay, guys, that's all I've got for you tonight. Good work. We will start chapter 6 next time. We may even finish it. Okay, because there's some things there at the end of chapter 6 that I'm going to ask you to look at on your own, because they go on and on for like a 2-3 point area. And I think we can use our time more wisely for our last couple of sessions after next time, doing some of the final review, and we'll even look at some of those things part and parcel of the final review. But anyway, I think we might finish chapter 6 next time. Question, start and finish. Okay, guys, have a good evening. I will see you next week.
Okay. Good night. Thank you.
Thank you, Professor.
Good night, guys.